My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be with my friends. I'm just trying to help you save some money. My job is not just entertainment, but to put days like today into context, because it is needed. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Wall Street, it looks like it's had it with the mega caps, doesn't it? We don't want to hear about the Magnificent Seven anymore. Everyone thinks these stocks are going to unsustainable levels so that they want to lock in gains and pivot to groups that have room to play catch-up, like the small caps. That's what's driving this vicious rotation we've seen over the past few weeks. Although today we mostly experienced the negative side of that move.
The House of Pain.
Dow tumbling 504 points, S&P plummeting 2.31%, but the tech-laden NASDAQ plunging 3.64%. Oh, they crushed tech they once loved as they slammed the door behind them. The proximate cause of today's sell-off, the allegedly weak results from Alphabet, parent of Google, and Tesla. I say allegedly because Alphabet actually had an excellent quarter, and while Tesla missed the earnings estimates, Elon Musk told a great story of self-driving technology, sorely needed energy production, not to mention humanoid robots. I'll have more on that later in the show. If not for the rotation out of big tech, I know this sounds like a stretch, but you have to understand, I think both these stocks would have been up today, especially Alphabet, which put up phenomenal search numbers, incredible results from Google Cloud. With $10 billion in sales this quarter, didn't think it was possible. There's some hair on the YouTube results, but that had more to do with tough comparisons versus last year, with Thermo and Shein, Chinese companies, flooding the streaming zone with ads last year. If you think of YouTube as the number one streaming platform, which we know Netflix talked about in its conference call, then you know that the results are pretty darn good. Let's stop kidding ourselves. It's a rotation. But the stock was up 30% for the year going into the quarter, and a highly visible division seemed to underperform. Hence today's 5% pullback, and it was ugly. Similarly, Tesla got crushed, down more than 12% today, because it didn't run so much into the quarter. But even though I thought everybody knew the quarter itself would be weak. No, everybody did. That's not the point. It's hard to hold on to those gains after a big run from the 170s during rotation out of big tech, of which Tesla is most certainly now big tech and not auto. So there you have it, the chipper and the shredder of today's market. Now, even though there's a rotation going on, you may not see the big cap money donated to the small caps on the same day. A day of ugliness like this might spare almost nothing, save a couple of large cap healthcare stocks. They can't all be like the day that started this rotation, where after a very soft June consumer price index number, the NASDAQ fell almost 2%, while the Russell 2000 small cap index jumped 3.6%. Look at that disparity, huh? The always brilliant Michael Semblis, the chairman of market and investment strategy at J.P. Morgan, pointed out that day saw the single biggest outperformance by small caps in over 30 years. Talk about a bell going off. Since then, we've seen the mega caps act terribly and the small caps act better. Of course, Semblis reminds us that the small caps are a very small part of the market. They haven't performed as well as the big caps over time because, frankly, they aren't as good as the big caps. Large cap tech has tripled the performance of small cap tech since December 2010, and most of those gains have come since 2019. Now, during this period, we've seen great. Let's start with FANG. Facebook, now Meta, Amazon, Netflix, and Google, now Alphabet. And then to the Magnificent Seven, which changed out Netflix and added Microsoft, NVIDIA, and Apple, all of which have been acting really miserably. I mean, geez, Netflix. I mean, that was such a great quarter, it didn't matter. NVIDIA, I think, doesn't matter. Amazon, they could have a good quarter, it won't matter. Not in this tape. No, it won't matter at all. So get used to what happened today. Is there anything that can explain the disparity between small cap and big cap? First, small caps are much cheaper in all sorts of valuation metrics, including the all-important price-to-earnings ratio. But there was a moment when Donald Trump looked like he had the election in the bag, and he favors heavy tariffs pretty much everywhere, which means the estimates may be too high for the big companies that import goods and do huge business overseas. Trump has also expressed a lukewarm allegiance to some allies, including Taiwan, which he believes stole our semiconductor manufacturing capabilities. So you can see how people would want to swap out of large cap tech and large cap multinationals and swap into domestic small caps. Although now the Democrats have rallied around Vice President Harris, well, maybe that trade won't be such a slam dunk. Finally, there's a growing revulsion toward artificial intelligence and the idea that it can produce big profits after investing billions of dollars. Both Alphabet and Tesla talked about massive spending on data centers, how much they need to do, with much of that going to NVIDIA's chips. Most of the companies that are in the Magnificent Seven are spending like mad on these things. And since the whole group is linked together by ETS, if you take down Tesla and you take down Alphabet, sell, then the other 5 all get crushed. Sell. But what are you buying in the rotation? Tricky question. Last week on Squawk on the Street, I went over some of the top 10 winners in the Russell 2000. They were a motley crew of already extended small caps that are losing a lot of money. It didn't seem like awful things to buy. This time I'm changing things up, and for our show, focusing on the 10 largest S&P 600 stocks by market cap that would be in the S&P Small Cap Index. This is what people are going toward. These stocks have already been huge beneficiaries of the rotation, but they might have more upside because they've underperformed so badly over the years. So let's talk about playing catch up and what it means. I'm going to give you the top 10 of the larger ones, okay? First is Fabrinet, which offers an outsourced manufacturing service for optical and electrical mechanical devices. Stock sells at 26 times earnings, but it's now given up the gains it made after the July 11th CPI reading and then some. Makes sense. This is an outsourcing play, and the whole rotation is about the end of outsourcing. Next is ATI, the old Allegheny Technologies. It's the best specialty steel company on earth, including stainless and tungsten. ATI has gone from 57 to 60, and it sells for 24 times earnings. Much of its steel goes into aerospace. I really like it. That's a small cap you want. Third is Ensign Group. This is a company that does nursing and rehab, sells at 25 times earnings. It's going from 130 to 136. This one works, too. Fourth is SPS Commerce, which offers supply chain solutions, a true enterprise software play, sells for 61 times earnings after rallying from 189 to 205. No thanks. Fifth is Mueller. I know this. I remember when it was spun off from an old steel company in the 1990s. Mueller's an old-fashioned metal bender, which makes aluminum and copper forgings cheap. 14 times earnings, even though it's gone from 57 to 65. I like it a lot. Six is Insight Enterprises, works with information technology and assembled devices, including those involving AI. Trades at 20 times earnings. It's already jumped from 196 to 217. I can't play. Seventh, Meritage Homes, good old home builder. It sells for 9 times earnings. After seeing its stock surge from 163 to 196, move too much. I prefer Toll. Eighth is a classic industrial, SPX Tech, which specializes in heating, ventilation, air conditioning. Trades at 28 times earnings, although the stock's unchanged since the rally began after getting hit hard last week. No thanks. I will take Carrier. Ninth, there's Installed Buildings, which installs residential insulation, garage doors, shower doors, and gutters. 21 times earnings, jumped from 221 to 248. I still like it. Finally, there's Comerica, considered by many to be the worst mid-sized bank in the country. Sells for only 10 times earnings, sports a 5.4% yield. That stock's unchanged since the small cap rally began because why? It reported a very weak quarter. You don't want it. These are very representative, though, of what the S&P 600 gives you. It's what everyone says when they say they're rotating a small cap. You just got the list. I want to point out that while many have run, some were left behind, yet most of them aren't that expensive. But maybe the particulars don't matter because big institutions just sell the Magnificent Seven, then buy the whole S&P 600 basket put together by brokers, even as one of the 7 is better than any of these 10. Let me give you the bottom line here. After today, many of the Mag 7 have gotten hammered so badly that they're actually cheaper than almost all the small cap stocks I just gave you on a price earnings basis. Then again, until we work through this brutal rotation, that newfound cheapness probably won't be enough to save the big caps. Only lower prices will accomplish that. Ouch. Mark in Iowa. Mark.
Good evening, Jim. How are you today?
I don't know. A little rattled here, Mark. A lot of my favorite stocks got crushed today when some really lousy stocks went up. So it's kind of upsetting me. What's happening?
Yeah, there were a lot of brown shoots, weren't there?
Yeah, that's exactly the problem. Lots of brown shoots. Why healthcare went up, too. Man, you are on the case, Mark, in Iowa. How can I help you?
Well, Jim, I'm seeing the story change for a company in the not well-liked EV space. They're entering into a partnership with an OEM company that will provide them with billions of dollars to further develop their EV software. Also in the deal, they will share their advanced electrical engineering expertise with that company. The partnership will lead to lower vehicle cost and faster advancements. Both companies will share many technologies, but will produce their own vehicles. with some time, how will this deal with VW change the Rivian story?
I think it takes off the existential problem of them going under. It doesn't necessarily make the stock a great price, but I agree with you. I think Rivian, if you wanted to buy 100 shares, you can buy 50 right here and then buy 50 down $2. After today's rout, most of the Magnificent Seven is actually cheaper than the small cap winners that I just wrote about and told you about. But until we work through this rotation, being cheap probably won't be enough to save them for now. Man, buddy, tonight, cloud juggernauts Salesforce and Workday are teaming up to create a new AI employee service agent to demystify the world of HR and finance, and also, I think, take on service now, frankly. I'm hearing how this new strategic partnership could be the key to the future of AI in the enterprise. Interesting. Then Thermo Fisher, TMO, struggling to find growth after big years in 2020 and 2021. So what is it going to take this to return to its former state? I'm talking to the company's top brass. Feels a lot like Danaher yesterday, doesn't it? And Boston Scientific hit an all-time high before pulling back today after a beat and raise quarter. The expectation is just too high of running into the quarter. I'm going to get to the bottom with the CEO. Man, do I ever like that story, so stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
A little over a year and a half since Wall Street started caring about artificial intelligence. And while we know its potential, we're still not quite sure where it will make its most use. Which brings me to this big announcement from Salesforce and Workday this morning. This pair of enterprise software titans have teamed up to create a new AI employee service agent, which will automate time-consuming tasks, provide personalized support, and give workers data-driven insights. They talked about several use cases for this employee support tool, like onboarding new workers, making changes to employee health benefits, career development actions, and many other tasks. It's all very interesting. In my opinion, this sounds like Salesforce and Workday forming a tag team to challenge ServiceNow, the leading player in back-office automation, which did report a very good number tonight. But before we try to extrapolate, let's get some more information from Mark Benioff. He's the co-founder, chairman, and CEO of Salesforce, and Carl Eschenbach is the CEO of Workday. Gentlemen, welcome back to Mad Money.
Great to see you, Jim, and hello from San Francisco, Salesforce Tower Ohana floor.
There you go.
Hi, Jim. Great to see you again.
Well, thank you for coming on the show, gentlemen. I think we should cut right to, Mark, a use case for the AI employee service agent. Tell us why we need this product, what we're going to be able to do now instead of what we used to do if we get this product.
Jim, as you know, AI is all about data. And if you have access to the data, you can have phenomenal AI. If you don't have access to the data, you don't get the AI. And the key to this announcement is we know that we're doing incredible AI for our customers because of the huge amount of data that Salesforce has, 230 petabytes. But now we're federating completely into Workday also. Yes. So we're bringing the Workday data set and the Salesforce data set together. That makes our AI even more powerful.
Now,
why that's important is that with this new agent technology that we talked about on the last show, Jim, all of a sudden you can have a service agent that's doing all your employee service. So all these incredible things that you can do with Workday, you can be able to do autonomously, and also this incredible new expanded data set. There's a whole new range of applications and capabilities that we could have never imagined. Plus, we're layering Slack on top of all of that. So this is really a next step for AI, the ability to kind of bring more and more data together. And as we read these stories about co-pilots and agents maybe not being able to know what to do or how to move forward because they don't have the data, this is an example of two companies coming together to make sure our customers have the data they need to deliver this incredible vision of artificial intelligence.
All right, so Carl, tell me, if I have ServiceNow, which does all this onboarding, and I say to myself, well, I don't know, these two companies that I like very much are getting together, but do I really need it? How much better is this than the current offering?
I think what's most important, Jim, and you mentioned this, Mark, is between the two of us, we have the three most important data sets in the enterprise: the employee data, the customer data, and the financial data. And what our objective of this partnership is to meet our customers' employees in the flow of work where they are. Now, through this new partnership and the data sharing we can do together, whether you're in Slack, whether you're in Workday, or whether you're actually in Salesforce, you can actually stay in those platforms and get access to each of the data sets that we have. You don't have to no longer jump out of either Salesforce or Workday going forward. We will meet you in the workflow and we will solve answers leveraging AI, both Einstein AI and the Workday AI that is unprecedented in the market.
All right, so Carl, you are a legendary investor. I mean, everyone knows both in the East and West Coast that you are an amazing investor. Would you have invested in this joint venture?
Well, thank you for saying that, Jim. That was a 6-year stint in my career where I was doing investing at the great venture capital firm, Sequoia Capital. But here today, we're focused on this partnership, an amazing partnership. I think this is a revolutionary partnership that will change the dynamic of how people leverage AI going forward. And it goes back to this. Between the two of us, the data sets we have are unmatched. And the only way to drive great outcomes with AI or generative AI is if you have a highly curated set of data. And that's what we both have. So if I were an investor, I would absolutely invest in this partnership alongside what Mark and I are doing.
All right, excellent. Now, Mark, this was a big backlash day. We had Ruth Porat was hectored last night with these questions on the Alphabet call about whether all this stuff is worth it. Is the spend worth it? Who has really made any money on AI? Who's really been helped by it? Why is the backlash so severe? And yet you and I both know that this is the next industrial revolution.
Jim, you are 100% right, because I'll tell you that we are on the march right now to Dreamforce. And both of us are really excited, and I'll tell you why. The theme of Dreamforce and really the power of what's happening right now in our industry and what we're really referring to is it's really humans with AI that are driving customer success together and humans with AI that are driving employee success together. This is a very different idea than even what was possible just a couple of years ago. You know, we've been doing predictive AI for a long time. You know, I've been using Einstein to figure out exactly what our sales forecasts are for maybe 5 years. And then, of course, we moved to generative AI. But now this idea of autonomous, wow, and this idea that we have agents that are acting on our behalf, you're seeing the expansion of our human sales forces and our human service forces and really our employee bases extended through artificial intelligence and agents. That's what we talked about, for example, on the last show, the idea that we're able to kind of open up a new sales territory with a sales agent, or do service deflection with a service agent, or in the example now with this federated data set, the ability for employees to get the access to the information they need through using this agent technology. This is humans with AI driving success together. That's a powerful new idea, and we have to get our head around that we're working in a whole new world, and not everyone understands what has happened with this technology, and it's incredible.
Yeah, if I could just add,
sure,
Mark, there is a profound impact here, Jim, for both employees and employers. We're talking a lot about changing the employee experience through this new announcement, but also if you're an employer, there are many things you can get through the integration of our data sets. For example, you can do precise workforce planning, taking a look at all the skills that you have in your workforce and matching it against the demand that you have from your Salesforce data. For example, think about doing continuous financial planning, leveraging Workday's financial planning platform, looking at the forecast you have in Salesforce, pulling those two data sets together and determining whether or not you're on track to meet your financial goals or objectives. And last, an example, Mark, I think that's really powerful, you touched on it, is if you're a sales rep, a Workday sales rep, you're in Salesforce because we use your platform, and you're working on a very complex deal. The system now will provide you prompts on what to do next to help close or accelerate that opportunity. So there are many different use cases for both employers and employees. That's the power of all the data sets we have coming together.
At the same time, Carl, I joined the company. I want to know my benefits. Normally I'd have to take somebody's time. I would have to get that person on the phone. Maybe they come back. Maybe I use Slack. Maybe someone gets back to me. But this way, if I have any question that's already in your data, it's answered what, in a second?
It is answered in a second. In fact, we think employee onboarding is a great use case for this joint partnership. We can accelerate from days to hours or from hours to minutes the onboarding of an employee. We also will provide a self-service HR agent through this partnership that answers all the questions. For example, if you want to know how much PTO do you have, What's my pay stub look like? What's my taxes? What are the policies? How do I update my benefits in this platform? That can all be automated through this new joint partnership and this new service agent.
Well, again,
and that's also why I'm so excited, because this idea that we're able to deliver this new generation of agent technology, this Agentforce platform that we've talked about, Jim, and how incredible it is. And then to see Workday building on that platform and delivering this incredible capability and integrating with the data cloud, all of our customers are going to benefit. Just last week, right here on this floor, I had Siemens, and Roland Bush, the CEO, amazing company. And it's a huge joint customer of both of us. We work with them very closely worldwide, standardized on Salesforce and standardized on Workday. But the vision for that means that they can have not only a customer service agent, an employee service agent, sales agents, all of these things working inside their company. That is a powerful next generation of what we mean for the global workforce.
Well, okay.
That gives us growth opportunities, all kinds of new opportunities to automate these tasks and deliver it. And it's because we're building this federated data set and with a common user interface with Slack. These three things together deliver this next capability of the enterprise, a new automated enterprise, as I said, where humans with AI are driving the success together.
I understand. I do want to focus just for a second on the competition. The competition, ServiceNow, does not offer the sales component. They don't offer the waterfall component for the CFO. Are you going to come in underneath them in price when you do this, or is it going to be something that you say, listen, you're going to?
No, Jim. What? Jim. They don't offer anything in this category. You're confused. Let me explain to you what Salesforce does. We're the #1 CRM in sales and service and marketing and commerce and in all of these critical customer touch points, 230 petabytes of customer information. This is the #1 HR provider, okay? And incredible financial provider. We use their financials and their HR.
Well,
okay.
USC and UCLA are not competitors,
you have to
right?
realize,
USC and UCLA not competitors.
Look, that's like saying that. That's like saying Wiener Schnitzel is competing with McDonald's. This is not. This is two different things we're talking about here. We're talking about how do we deliver the next generation of customer experience, the next generation of the employee experience. How is it that humans with AI are going to drive this success together?
Sounds like apples and oranges to me, then, gentlemen. Right? Apples and oranges.
Again, I think what's
Jim,
important.
this idea, this vision, Jim, that you need to federate your data, get these data sets together. You need to automate, your customer touch points. You need to be able to deliver these agents. You need to be able to deliver the analytics, by the way, with things like we have like Tableau that we're working on together as well. All of these things together make up the next generation enterprise. And that is what is going to drive innovation and growth and profitability and margin and productivity and augmenting our employees using these amazing new technologies.
Excellent.
That's what we're excited about.
And Mark and Jim, if I could just add, if you think about this exciting strategic partnership we're announcing today, it really started 25 years ago when, Mark, you pioneered the movement of, your CRM platform to the cloud. 5 years later, our founders here at Workday, right, David and Neil pioneered moving HCM and eventually ERP to the cloud. Fast forward 20 years later, I called Mark 5 months ago and said, we have the three most powerful data sets and system of record in the enterprise between our CRM, between our financials, and between our HR. We need to come together because there's no two companies provide that level of data set for the enterprise other than Workday and Salesforce. And that's the exciting part of this. And it's all automated through
Jim,
the use
I'm going to have to move on, but thank you for explaining to me and to everybody the importance of this joint venture. Thank you, Mark Benioff, CEO of Salesforce. Carl Eschenberg, you will see me at Dreamforce, absolutely. And Carl Eschenberg, CEO of Workday. Elton John, fantastic. And Mad Money's back after the break.
Coming up, Thermo Fisher turned in a sterling quarter. Cramer digs into the scientific method. Next.
Whenever the market's melting down, you need to search for stocks that can triumph over the gravitational pull of the averages. Today, Thermo Fisher Scientific pulled it off. I like to describe this company as an arms dealer to the life sciences industry, and this whole group had an extended post-COVID hangover because so many biopharma outfits ordered more equipment than they needed during the pandemic. At the beginning of the year, though, I told you that the life science stocks were ready to make a comeback. And today, Thermo Fisher delivered, reporting a strong revenue beat with a 25-cent earnings beat off a $5.12 basis. On top of that, management raised their full-year forecast. If you believe Wall Street's consensus estimates, this should be the last quarter of revenue shrinkage for a major pickup in the second half. If that's the case, then I bet the stock has plenty more room to run, and I'm saying that even after it gained more than 4% today. So let's go straight to the source with Mark Casper. He's the chairman, president, and CEO of Thermo Fisher Scientific. To learn more about the quarter and what comes next, Mr. Casper, welcome back to Mad Money.
Jim, it's great to be back with you, and thanks so much for having me.
Well, Mark, it is great to see you, and it looks like it's so hard for people to understand. They'll see some minus signs. They'll see some things that don't look like Thermo Fisher. But the fact is, because of COVID, there was a distortion, and now all of your end markets seem to be turning, which gives you the same old kind of long-term roadmap that we're always used to from Thermo Fisher.
Yeah, Jim, it was really encouraging second quarter. Another quarter in a row of playing out as we expected and allowed us to execute well and beat our numbers and ultimately raise our guidance. When I think about our end markets and really where investors were paying attention was, would we see the improvements? And what was great for Thermo Fisher is we sequentially improved our growth in all four of our end markets, and that certainly bodes very well for the second half.
You're also talking about picking up some market share gains. Is that from other companies here, overseas? Where are those gains coming from?
Yeah, when I think about the company's long track record over many years, we've been able to grow about 3 points faster than the market, and that's been consistent in the most robust of times to even the more challenged times. And when I look at this particular quarter, and we clearly had another very strong performance of growth relative to others, you could see it in a few of our key businesses. In our clinical research business, which we acquired 3 years ago, we look at things like authorizations, the new clinical trials that we win, and we had a very strong set of performance. When I look at our bioproduction business, the business that's used to help produce medicines, again, very strong step up in performance. And one of our largest businesses, analytical instruments, having 3% growth in the quarter, clearly outdoing many of the peers. So very widespread, broad-based, and really great execution by the team, and I couldn't be more proud of the efforts that they're making.
I also know Thermo Fisher is an outfit that always comes up with some incredible new products. We call them high-impact innovation. What do you have for us this quarter?
Yeah, so actually Q2 was a very strong quarter. I'll really focus in on our mass spectrometry products. That's our highest-end instrumentation used to advance life sciences research. At the scientific conference that happens each June, we launched in this year the Thermo Scientific Stellar mass spectrometer used for protein research to help identify the right biomarkers to ensure the efficacy of a medicine. And the excitement from our customer base has been hugely positive and bodes well for our growth going forward.
Are we seeing enough companies, biotech companies, come public that will have enough money to be able to buy the equipment that they need, equipment from you that they need to be able to grow?
Yeah, so Jim, when I think about the trajectory in biotech in terms of funding, right, you saw in the fourth quarter M&A activity return with larger companies buying some of the smaller companies. In the first quarter, you saw the venture capital money start to really flow back into biotech. A reasonable quarter again in the second quarter. In fact, I think about funding. In the first half, I think we had as much funding going into biotech as all of last year, just in the first half. And I think that bodes well for the IPO window, although you're much smarter than I to know when that window is really going to open.
I just was glad.
But clearly
it's good. It's good. Now, let me ask you about another thing that's different for you, although we do have Boston Scientific, but you're the other company I saw that had good numbers in China. A lot of people are waiting for China's stimulus. You obviously don't need to wait for stimulus. You're getting the orders right now.
Yeah, so when I look at China, while the economic environment is still challenging, the government has announced stimulus programs, which should affect us late this year and certainly into 2025 in a very positive light. The team did a good job. We were able to deliver about 5% growth in China against certainly above the expectations of our external investors. And I'm proud of the team's efforts to really serve the customers well. Really strong demand for our instruments business, particularly in China.
Okay, now I was really pleasantly surprised to see the balance sheet optionality. You have $7.25 billion in cash. That means what, for buybacks, or if there's something out there to buy, you'll be able to snap it up.
Yeah, so when I think about our capital deployment approach, it's been a proven one that's created a lot of shareholder value. We have a balance of return of capital as well as M&A. This year, we've already returned about $3 billion in buybacks in the first quarter. We just closed in July a $3 billion acquisition of Olink, a very exciting company that's adding to our proteomics research offering, one that's a high-growth business. And we have a strong balance sheet that allows us to continue to find opportunities to add to our portfolio and create even more value for our shareholders. And in an environment like the one we're in now, Thermo Fisher is really poised to be able to capitalize on those opportunities.
I totally agree. It's really just the second great quarter, and it's obviously Thermo Fisher's no longer clouded by all the great work you did, frankly, when COVID was raging. And that was great work, and you had to do it because it's who you are and who your company is. But now I got what I remember as Thermo Fisher, which is just beat and raise, and do all the right things. And I thank you so much to Marc Casper, Chairman, President, and CEO of Thermo Fisher Scientific. Marc, this is a really clean quarter. Thank you so much.
Thanks for having me, Jim.
Of course. Mad Money's back every break.
Coming up, Boston Scientific has seen sales surge. What's at the heart of the game? Stick with Cramer.
I gotta tell you, I really feel for the great companies that had the misfortune to report terrific numbers on a hideous day like today. Take Boston Scientific, the major medical device maker, which delivered an extremely strong revenue beat with 14.7% organic growth, while earning 62 cents per share. Analysts were looking for 58. On top of that, management even raised their full-year forecast substantially for both revenues and earnings. Yet the stock got hit today, trading down about 1%. Some of that's the ugly tape. Some of it's because Boston Scientific had already run up 36% for the year going into yesterday's close. So maybe it was due for a pullback. I think it's a buying opportunity. Don't take it from me, though. Let's check in with Mike Mahoney. He's the chairman and CEO of Boston Scientific. He had a better sense of the quarter. Wow, Mr. Mahoney, welcome back at last to Mad Money.
Thank you for having me, Jim. It's an honor to be here.
Oh, please, the honor's mine. You have delivered and delivered and delivered, and you did it again. For those of you who perhaps not familiar with Boston Scientific, you're a manufacturer of medical devices, minimally invasive. But why don't you talk about some of the composite of this amazing quarter? And then we got to talk Farapulse, we got to talk Watchman, and we got to talk Silk Road, which was a brilliant acquisition.
Do we have 30 minutes?
I wish we did. I love your company. Anyone who's got a heart problem knows your company. And if they don't, they should, because that's how excellent your science is. Why don't we, top level, whichever one you want. Maybe it's Watchman you want to start with.
I'll give you a breakdown.
Okay.
First of all, I'm so proud of what we've done as a company and our global employees around the world. You know, over the course of 10 years, Jim, I'll talk about the first half and the quarter in a second. Over the course of 10 years, we've consistently increased our organic revenue growth, the markets that we serve, and our EPS growth while improving margins. So we've really had a strong track record of consistently delivering results and strengthening results, and we're really looking forward to the next chapter. You know, the second quarter was fantastic. We grew our top-line business 15%, as you said, about 15% EPS growth. For the first half, we're at 14% organic growth and 18% EPS growth. But what's amazing about it, besides the innovative technology you want to talk about here, is just the balance of the growth around the world. We grew double digits in Europe, Asia, and the U.S. And our cardiology businesses, as you called out, we have 8 divisions in the company, but our 4 segments within cardiology grew over 20% for the quarter, with standout performance from 2 big areas. One is our electrophysiology business, which is our EP business led by Farapulse, which grew in the U.S. 200% and 100% globally. And our Watchman franchise, those 2 businesses are uniquely special in medtech, where we have a significant competitive advantage and significant room to grow.
Now, you actually had good numbers in China. No one has good numbers in China. How mission critical is what you do that you actually had great numbers in China?
We have great numbers in China. We have a terrific team in China. Jim, it's always about the strength of your team, the engagement, and your innovation portfolio. And that's what we have in China. We have a diverse set of businesses in China. It started off years ago with just drug-eluting stents. Now drug-eluting stents is a small part of our portfolio. We have a wide business within peripheral interventions, oncology, endoscopy, urology. That business grew mid-teens in the quarter, despite some of the pricing challenges and macro challenges. But there's about over 1 billion patients in China, and we are a healthcare company first. And they have significant demand for our products. And it's a very competitive market, but our local team finds a way to work with customers and really outpace our competition in China. And we expect to do that along with the entire global company for many years to come.
Now, this Silk Road acquisition, which I thought was brilliant, because when you go to a cardiologist, he says, listen, we got to measure your carotid artery. No one even knew 10 years ago or even 5 years ago how important this is. This is just incredible science, this T-CAR. Can you tell us about it?
Sure. So we have many products that impact stroke. Farapulse for EP, Watchman, that reduces the risk of stroke and gets patients off blood thinners, and now Silk Road, which we haven't closed yet, but we anticipate closing in the second half of this year. They're really the pioneer of what you said called T-CAR. So patients oftentimes will have carotid artery disease where plaque will build up in your carotid artery. A very dangerous condition. The common treatment prior to this was surgery. And anytime you have surgery, it certainly works well, but it's a longer recovery period. And they have an interventional technique to remove that plaque and free up that stroke risk. And they really are the pioneer there with great clinical science. It's a growth that will be accretive to the company. And we'll also take that product internationally outside of the U.S. And our operations team will do a great job working with them as well. So it's a terrific addition. M&A in general, Jim, has been a big part of our story. We've acquired about 35 companies since I've been CEO. And we have a very active venture portfolio of about 40 companies in our venture portfolio. So we're very active globally, scanning investments, bringing small companies into Boston Scientific, taking the best of what they have, but growing them up and expanding them around the world.
But I also think that it's even better than that. A lot of companies buy a lot of companies in your area, and then you never hear them again because they really are busts. I mean, I see these numbers, and you've got so many double-digit winners after you buy them. So someone is making judgments. Like when I saw Silk Road, I said, how come some bigger company didn't get that? And the answer is Boston Scientific. You're very nimble, you're very quick, and you've got a real clear mission when it comes to the heart and when it comes to, let's give an example. When you talk about Watchman, this is something you close. You literally, people have to know this. The device is designed to close the left arterial appendage in those with AF. I mean, you actually close the appendage, and that's okay.
Yes, it is. So this is a product that we pioneered through multiple years of product technology and clinical innovation to finally get approval in the U.S. So, Jim, patients with atrial fibrillation, which is over 30 million of them, have a higher risk of stroke. And many of those patients have a hard time with blood thinners, either at high risk of bleeding based on their occupation, or they just can't manage the blood thinners, or they're non-compliant, which about half the patients are. So the beauty of Watchman, which is a procedure that lasts maybe about 40 minutes, and patients are in and out within 4 or 5 hours routinely within the hospital. This device will reduce the patient's risk of stroke and enables patients to get off blood thinners, which is a terrific win for patients. The healthcare economics works for hospitals very well, and the doctors can perform it incredibly safely. And as importantly, we're doing the clinical science work to make this potentially first-line therapy versus blood thinners. So this market, which we've created, could turn into about a $6 billion market over the coming years as these new clinical indications expand.
Wow. Okay, I believe that because you've been able to deploy these ideas and really make them into major hits. I'm just very impressed with you. I know everybody here always say, oh, that darn Boston Scientific, when are we going to get them on? And the answer is, you came on when we answered. I really appreciate it. I also want to thank Dylan Reebok, who called and said, look, Jim is just desperate to have you on because you are such a winner. Mike Mahoney, Chairman and CEO of Boston Scientific. Thanks for coming on the show.
My pleasure. Thank you very much.
Absolutely. Man, I want to be back after the break. It is time. Start with the lightning round. Chris Burton, that's for Ralph Gold. I'm saying in the stock. I'll tell you about buy, sell, disregard, and the core stock question. Tell my staff, Chris, you play this out. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. Let's start with Charles in New York. Charles.
Hey, good evening, Jim. This is greetings from Long Beach, New York. I'm curious what you think about Audia.
I know it. And you know what? In that same vein, in same kind of Venn diagram, I would actually put Trade Desk, TTD, which was down very badly today off of Alphabet, and I think that's the one you want to buy. I need to go to Josh in California. Josh.
Jim, thanks. Bald is booyataful. Now, with
completely
the
right.
petrodollars, $35 trillion in debt, imminent transition to CBDC, is it time to follow Warren Buffett and buy precious metal miner stocks like Hecla Mining? Give it to me for the win.
I have always been a believer in the gold stocks. It's not always worked out, but right now it is. Yours is good. I prefer actually a mutual fund that has them. I think that may be the best way. That way you avoid getting stuck with a stinker. Let's go to Dave in Illinois. Dave.
Dr. Cramer, my good mad friend. My stock for today is little Jumia Technologies. Have you heard of it?
Yeah, it's not making a lot of money, Dave, so you have to woo me on this one.
Good afternoon, young man. This is Mary in Idaho, and
Dave.
I wanted to get your recommendation on a stock, Broadcom, symbol
I like Broadcom. It's owned by my
ABGO.
Travel Trust. I think it's absolutely terrific. It's going to get hammered along with the rest of the rotation. And might just say, by the way, my love is still also with Dave from Illinois, and it's killing me. Dave's like the land of Lincoln. It's the land of Dave. So I didn't mean to cut him off. Boy, but what can you do? Sometimes things happen, and I apologize. I want only a lightning round with Dave tomorrow, nobody else. Let's go to Jury in Ohio. Jury.
Yes, I'm interested in AVAV, Arrow.
You know what? Okay, let me give you the bull and the bear on AVAV. My friends who watch the show say, Jim, you don't understand. Their stuff is way too expensive. It needs to come down versus the price of the Iranian drones. All I know is the drones work, and therefore it's a buy. And that, ladies and gentlemen, is the conclusion of Dave's Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, Tesla for the long term? Why their bankable CEO is himself a reason to believe. Next.
Last night I was reading through this Tesla conference call for a second time because it was so meaty, and my wife called. She said I sounded down, and I admit I was really bummed. I told her that the source of my chagrin was none other than Elon Musk. What did he do this time, she said. She thought it was something political. I said, he didn't do anything. I just knew that no matter how hard I worked, no matter how hard I studied, I could never be as smart as this guy. Even watching Tesla fall 12% today, it's impossible for me to appreciate the schadenfreude. Why? Okay, allow me to unburden myself to you, because it's the only way to understand what Musk has got going for him. First, understand that last night's conference call was like nothing I've ever heard, even from Tesla. The auto business, the plain old Tesla, disappointed people. They aren't selling as many cars as we thought. They aren't doing anything overtly revolutionary. No 2-minute battery charge the time it would take to fill an SUV. No engine that can give you 600 mile per charge. But it wouldn't surprise me if Musk actually cracks the code for both of them. Instead, he's wowing us with talk of the most advanced humanoid robots in the world. He thinks that the long-term value of Optimus, his robot initiative, will exceed that of everything else Tesla has done, and it will be worth trillions because we all will want a robot. You got to wonder how much of that is real, but even if a fraction of that humanoid robot story comes true, shareholders will make fortunes. Then Musk's talking about autonomy and the joys of the fully self-driving vehicle that he thinks will soon be ubiquitous in every country, including ours. Sounds preposterous? Musk says, and I quote, if you've got billions of miles that show that in the future, unsupervised full self-driving is safer than human, what regulator could really stand in the way of that, end quote. He argues it will be part of a customer-owned fleet, kind of like an Airbnb on wheels. He's betting autonomous driving could be a $5 trillion business. And then there's Tesla's energy business, specifically the energy storage backlog. This quarter, energy storage deployments more than doubled, giving the division record results small, but doing incredibly well. Plus, while Musk called out NVIDIA as a darn good manufacturer of high-end chips, he wants to go against NVIDIA, too, because he can't get enough of their best semis. I believe it, but not anytime soon. Now, the irony is, despite Musk's best efforts, today was a day when people said Tesla's just a car company and nothing more. It doesn't have anything near-term that can justify the stock's current valuation. He told a great story in the call, but nobody cared and gave him the downbeat environment for the mega caps, of which he has one of them. Perhaps you have to buy this week just because of the future, which seems very bright. I actually think that it makes sense, at least as a place to start buying. What matters is that you have to wait. You have to be patient. You have to be long-term oriented. Trades that are in short supply on Wall Street. As I see it, the key risk with Tesla was that Musk might leave over his pay package. Now that he's staying, I recognize that he's just better than everyone else when it comes to envisioning the future. Perhaps with the sole exception of Jensen Huang from NVIDIA, who is also, by the way, a lot more fun to hang with. Still, Musk's bankable, and the rotation out of the Magnificent Seven could give you a chance to put his genius to work for your portfolio, and it's probably right here worth taking. I like to say there's always a bull market somewhere, and I promise you to find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.